You're about to join Niels Kostrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Dunne and I, Niels Kostrup-Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. If you're new to the show, I hope that today's episode will trigger your curiosity enough to check out the back catalogue and listen to the past episodes that you may have missed, like last week's episode with Rob, where he had prepared a detailed framework as to why he believes that trend following wins the KGAR race compared to other strategies that seemingly look better on a risk-adjusted basis until, of course, you start to dig into the details. I also would encourage you to listen to the midweek episode where Kevin Coldiron spoke to author James Fogg, who has written a very interesting book about the financial Cold War that we are experiencing between the US and China. And he does that from the perspective of someone who's born and raised in Hong Kong and who actually worked for the parent company of the LME exchange, which, as many of you know, had a serious issue with a few months ago, where it looks like they had a plan to bail out a large Chinese tycoon at the expense of other investors. Anyways, Alan, great to be on the podcast with you, as always. How are you doing? How are things in Dublin this morning?
Great. Good morning, Neil. So all is very well over here. Beautiful summer sunshine, and just watched Ireland beating the All Blacks this morning. So that was a monumental win for the Irish. So we're delighted about that.
Nothing like a win like that to cheer you up, right?
Exactly.
So on the economic front, the Fed Governor Chris Waller, he tipped his cards this week on Thursday regarding the Friday unemployment report, saying the robust labor market gave him confidence in the strength of the U.S. economy. And the report showed that the economy did indeed add 372,000 new jobs in June, well ahead of the 265,000 that was expected. Given the anecdotal weakness we've been witnessing, it was expected that the jobs figures would disappoint. His comment on the jobs was in addition to him saying that he favored another 75 basis points hike later in the month. That rate hike recommendation was echoed, by the way, by the St. Louis Fed President James Bullard, and both are voters on the rate decision committee. Contradicting the headline number, the household survey showed a decline in the labor force of 353,000 jobs, but from the media's perspective, the establishment survey is the go-to number, and Friday's report will undoubtedly be supportive of 75 basis points hike that Waller and Bullard are calling for. Earlier in the week, the minutes of the June FOMC meeting were released, and the tone was decidedly hawkish, arguing for another 75 basis points hike at the July meeting. The flaw in that logic, though, is that the minutes are 3 weeks old, and since the rate hike, economic strength has clearly cooled, and many of the runaway commodity markets have come off the boil, as has the demand for mortgages. Now, the Atlanta Fed GDP Now, a real-time economic forecasting tool, registered a minus 1.86% for Q2 GDP. And if that forecast comes to pass when GDP is released later this month, the US will officially have been in a recession for the entire time of 2022, and the Fed has been tightening into it and continues to do so. The fact makes the employment discrepancy more relevant. Now, looking into next week, investors will likely face down another worsening inflation report on Wednesday, with CPI set to rise 1.1% month-on-month and 8.8% year-on-year. Second quarter earnings will also begin to trickle in as well, with JP Morgan and Morgan Stanley both reporting on Thursday and Citibank reporting on Friday, and no doubt investors will be listening closely as the three CEOs offer their assessment of the economy and the consumer. But let me get back to you, Alan. But in addition to the rugby, what have you been focusing on the last few weeks since we last spoke?
Yeah, it's interesting, as you touch on. I mean, we've seen some interesting trend shifts in the markets, corrections of some of the major trends and reversals elsewhere. So, as you say, in terms of the commodity markets, a lot of those uptrends which had been in place since the end of COVID or since 2020 have now reversed. So particularly copper and some of the grains, oil starting to top out. Maybe hasn't weakened as much as some of the others yet. And in the fixed income markets, obviously, we've seen a correction too. So it's interesting how, we had that burst of, pessimism around inflation immediately after the last CPI print. But since the FOMC meeting, the market is, it seems to be more worried about growth than inflation now all of a sudden. So that's an interesting dynamic. Obviously from a trend perspective, trend following is agnostic. Interesting that, performance has held up even in the face of those corrections and reversals. And that's probably because, we've seen a very strong trend in the US dollar, which has, dollar index breaking out, the euro down to 101. So really we've had this kind of baton being handed over through the markets throughout this year, from one market to the next in terms of which ones are trending, and now it's currencies. And actually, it had been one of the unusual features of this period that we'd seen that dollar rally and commodities rising at the same time, because many times throughout history we've tended to see commodities going up when the dollar is going down and vice versa. So we're probably back into a more normal relationships between commodities and the dollar at the moment, but certainly that's what the market is saying. There's more of a concern about growth. Of course, the irony about all of this, if there's too much of a concern about growth and yields fall, that eases financial conditions, which is not really what the Fed wants at the moment. So as you say, the minutes are very hawkish. And I thought it was noteworthy they were talking about taking policy too restrictive and then possibly even more restrictive. So certainly the tune from the Fed is hawkish and getting more hawkish, even though the market is getting more worried about growth.
It's very strange, I have to say. And there are so many of the people that I have a lot of respect for that are completely in disagreement as to what's going to happen next. And I have to say, if as I was trying to look at it from a quote-unquote fundamental point of view as to where things stand 6 months from now, I really wouldn't have a clue. And I'm so grateful, really, that that's not what we need to worry about. We just need to worry about the the price and react to that. Funnily enough, on that note, and I tweeted about this week. Not that I do many tweets, frankly, but I did hear Tony Robbins actually in a recent interview talk about how leaders anticipate and losers react. And I was thinking about that. I think that's funny because in investing, that's, in my opinion, completely opposite. Of course, being biased because trend followers react, we don't anticipate anything. So anyways, just a little funny story.
This doesn't necessarily carry over into investing, I guess, was your point.
No. I mean, I've met few people, I would say, that consistently anticipate correctly. Let's put it that way. But there we are. Now, from a trend following point of view, just trying to give a little bit of an update for the week. I have to say, I was thinking about it this morning, and I think this week might be pretty hard to call in terms of industry performance, in the sense that I've heard some people say, including some of our co-hosts here, that it was a really tough week this week, mostly because of the sell-off in many of the commodity markets like the energies and the grains. But then on the other hand, as you refer to, we did see a pretty strong dollar. That should generally be good for trend followers. That's because that's along with the major trends right now. And we also saw a little bit of a pickup in the downtrend of fixed income markets this week, in the last few days in particular. That should also be helpful. And then the other thing actually I thought of was that maybe next week we might get a little bit of support for energy markets, because I noticed that Russia is going to turn off all the gas to Europe on Monday, because they do this every year. They do like a 10-day maintenance thing on I guess it's the pipelines. But I did notice that some people actually are worrying that they're never going to turn it back on again. And then, of course, Europe will be in a very tough situation. And I have a feeling that prices on gas, at least, will be going higher. We'll see. In other sectors, I really don't expect that there was a lot of impactful performance this week. But, we are in some kind of transition phase right now. So even subtle differences in system design and risk management could make up for some return dispersion at the moment, I guess. But when I look at the industry numbers, which I'll come to in a minute, it does overall look like the week was, not too bad, maybe a little bit down. On our own side, actually, was pretty, it was actually a little bit up. So we'll see how it all pans out. My own trend barometer finished the week at 52, so that's still in the positive territory, suggesting that the environment is still okay for trend following. But let me just do the rundown of the numbers and we'll see where they are. Beta 50 index, and these are as of Thursday, down 0.5% for the month of July, up 15.95% for the year. SocGen CTA index also down almost 0.5%, 47 basis points, up 20.57 for the year. Trend index down 76 basis points, up 27.99 for the year, and the short-term traders index up 0.42% for the month and up 11.82 for the year. Comparing that to the MSCI World Index, that's up 2.25 for the month so far, but still down 19.5 for the year. And the World Government Bond Index down again this month, down 20 bips. And that's, I think, the 8th month in a row it's down. So definitely fixed income markets are struggling. And we've got we got a really good question in from Matthijs, and then we got another question in from Eduardo, and they are somewhat related. And they're actually also somewhat related to some stuff that you had thought about bringing up. So I think it's going to be one big conversation today about this topic. And I actually think it's a great topic because I think it's something that a lot of investors are thinking about right now. Maybe how do we design our portfolios overall for the environment we're heading into, and how do we combine different type of strategies to better withstand some of these shifts that we see in the economy and so on and so forth. So I think what I'll do, if you don't mind, I think I'm going to read Matthijs, and I hope I pronounce your name correctly, Matthijs, questions first. That will lead us into sort of the question from Eduardo, but also going to lead us into the papers that you have, and then I'm just going to let you run with it, and then I'll try and keep up, so to speak. So let me go into the first question here and set the tone of the conversation. Matthijs writes, thank you so much for all your wonderful podcast. I feel like I've learned so much from them. I'm a computer scientist working on topics relating to statistical computing. So the approach of building a simple automated system that is optimized based on backtest while avoiding overfitting is very appealing to me. I've been working on implementing my own system mostly for fun right now, but hopefully it will one day get to the point where I can use it in practice. For now, I have a couple of questions relating to investing through other managers, and I haven't been able to find the answers in your podcast so far. So question number one, what are your thoughts about return stacking, the idea of an overlay of trend following on a margin account that holds a diverse portfolio of stocks and perhaps bonds, as discussed by Corey Hofstein and the Resolve and Apperson teams? Number two, relating to that, how should we think of the risk to such stacked portfolio where we have stocks and other risky assets in our margin account rather than cash? How do we determine how much stacking is responsible and where it becomes too much leverage? For example, I've heard of people who have a portfolio of 100% small cap value stocks with effectively an overlay of 100% managed futures in this setup. Isn't that incredibly risky in terms of actual blowing up? The risk I care about is being wiped out, not so much volatility. And then he goes on to say, relating to my question, perhaps a natural third question would come up in the discussion, namely number three, is an overlay/return stacking approach only responsible for trend systems that targets a particular volatility? So we have some idea of the size of the margin requirement brackets, so not safe with a system like Jerry's. I would also be grateful if you could discuss some of these questions in a future podcast to point me to past podcasts if you've already discussed them before. Well, actually, Matthijs, we've kind of touched on them before, but not maybe as a specific topic. So we'll be very happy to deal with this because I think it's actually a really great topic. Let me set the stage a little bit for you, Alan, before you jump in on this, because this concept of return stacking, so to speak, of combining things with trend following, obviously I've also noticed that there are some papers that's been written about it in the last couple of years. And it's kind of been put forward as kind of this new idea, this novel idea of you can do this. But I just want to share a little anecdotal story, because to me, this is not new at all. And it's funny because actually when I worked for Jerry back in the mid-90s, we almost did this. We called it portable alpha. And our idea was to take the return of an S&P 500 and just overlay one of Chesapeake's strategies, not the diversified one, but they had a one that called financials and metals, I think, and just overlay that. So this idea, this concept of adding quote unquote trend following or managed futures to traditional assets as an overlay or a very cash efficient way of doing this and obviously getting the benefits that I'm sure you'll touch on, to me is not new, but I do agree that there is more talk about it now than before, and I do recognize some of the great work that Corey and the Result guys have done, as well as the Apperson teams. And there are others out there that I'm sure I'm forgetting right now. And of course, Eric over at Standpoint, they've done something similar, which we've discussed. So not new to me, maybe new to many people listening to us today, but I think it's an interesting idea. It's an interesting concept. So I'm very curious to hear your thoughts on this.
Yeah, absolutely. Agree with you, Niels. It's not a new concept. I think it is a new label. I think that's what was really valuable and interesting about the piece from Corey and Newfound Research and Resolve. It was putting this return stacking label on it, which I think people found quite informative. But as you say, plenty of managers have been running these strategies going back a couple of decades. I think it's probably been something that has been, in the managed futures domain, and now it's maybe going a bit more mainstream. I think that's the point. I think there's certainly merit to it. And, we also see this in institutional portfolios as well, with, the likes of CalPERS now looking at using a bit of leverage in their portfolio. And I think we'll probably hear more and more about it. So, absolutely, there's nothing wrong with it. It's a good idea. I think it comes back to something we touched on a couple of episodes ago, and it's certainly come up in the allocator series. The idea of, building a diversified portfolio in the first instance, that's what modern portfolio theory would tell you. And, I mentioned kind of Tobin's separation theorem before. You figure out what's the right asset mix, and then secondly, decide how much leverage you want to have in the portfolio. So from the same perspective, it makes sense to combine different risk premia, so asset class risk premia versus, if you want to call trend a factor risk premium or whatever you want to call it, but it's something uncorrelated. So it certainly makes sense to combine them in a portfolio. And then the second question is, what's your risk tolerance, or how much do you want to hold? And obviously the fact that managed futures and trend following is done on leverage and in futures lends itself to getting that leverage. You don't have to go and borrow and then have all of those kind of issues around having a bank loan and possible refinancing risk, etc. So futures trading really lends itself to this type of approach. I think the other aspect of this, that why it became popular in the last few years, was maybe a little bit of a bull market phenomenon, in the sense that, certainly my experience, if you go back to the end of the, 2019, so the end of the last decade, we'd had such a strong run for the S&P and beta. People were reluctant to diversify because it was a perceived opportunity cost of diversifying. So if you could hold on to your beta and get to diversification as an overlay, then that was seen as attractive. So I think that was another part of the narrative as to why we're hearing a bit more about this. But I think in terms of the question, how much makes sense. Obviously, the key thing you want to do with these, with kind of any return stacked portfolio or any levered portfolio, is to ensure that you have diversification, and I mean, not to rely on, I guess, past correlation. I mean, if you just levered up the 60-40 portfolio, you'd be in the midst of a deep drawdown this year, because, obviously equities are down, bonds are down. So you want to have strategies there that you have, economic reasons why they're going to be uncorrelated. And obviously trend following lends itself to that, because historically, I had a quick look, it has been negatively correlated with small caps. It's been negatively correlated over the long term, slightly negatively with most equity indices, I would say. So certainly trend following lends itself to that. How much could you do 100%? I think you could. I mean, obviously if you have 100% practically, how do you get 100% in small cap exposure? You presumably you have to buy those stocks. So then, where do you get your extra cash for your managed futures? Do you have to borrow? I'm not sure what he's getting at exactly. But if you get your equity exposure via futures, then you have plenty of spare cash to invest either in a managed futures program or a fund or whatever. So I think you could certainly do 100% equities via futures and another 100%. I mean, a lot of this depends on what vol your managed futures would run at. The thing is that with that portfolio, because of the correlation, the volatility would actually not be, it might actually come down because of the dampening effect of the managed futures. I think there's a few other things you have to think about within this, and it kind of depends on your utility function. The big risk with this type of approach is that you get a 2018 type scenarios. You might remember 2017 low vol in equities. So on your trend side, you were levering up your equity exposure. And then you had your core long equities from your passive beta side. So coming into 2018, you would have been very exposed to long equities, and then you get a sharp reversal like we saw in February 18. So if you're not comfortable with that type of drawdown, now you say you're more worried about risk of ruin than volatility, but sharp drawdowns like that can be painful with a strategy like this. And actually, my experience around this is that some investors who do this or variants of this were quite focused on this risk back then, and it led to a lot of discussion around the nature of the trend following program you might employ. So some people were thinking, if I'm going to run this type of strategy, well, one, I might want to be faster with my equity or with my managed futures trend following program, or two, maybe I want to go with a capped equity beta or a capped equity exposure variant. And this is something that's come up amongst Jerry and the guys as well. CFM launched a product not so long ago that has a capped equity exposure, and I know Graham have a capped equity beta exposure. So there's pros and cons of that as well. But the point is that once you start combining these things, there are these other considerations, certainly around speed and risk allocation, and if you want to put any constraints on from an equity exposure perspective. So yes, makes sense. I think it's a good idea. I think it's interesting that there is this, my experience looking across Europe in particular, we have a big kind of multi-asset fund market, and there's this basic kind of concept that you just, your exposures add up to 100%. But obviously there's no real reason why it has to. Obviously we can use futures for leverage and for capital efficiency. But when you say that, I think naturally people get cautious, futures, risky, derivatives, but it's knowing how to manage the risk. And that's by incorporating proper diversification, and then being comfortable with normal ups and downs in it. So I think there's a lot to think about in there, but certainly it's an absolutely valid approach.
Yeah, no, absolutely. Hearing you talk about that, it reminds me actually of another thing that happened when we were doing all of this work back in the 90s at Jerry's shop, and one of my other colleagues there, a guy called Tom, he had this great one-liner that he came up with back then, and I really think it is worth paying attention to, because I think it's true. And that he says, he always said, I can't remember if he used the word managed futures or trend following, but he would always go like, trend following allows you to own equities. And that's a very interesting statement if you think about it, right? Because as you rightly say, for the most part, what it's going to do, it's going to dampen your volatility and it's going to increase return. Now, that is something we've said since the early 80s when Dr. Lindner came out with his paper, right? We've been shouting that for ages, maybe not in the last couple of decades, because it just got, people didn't really want to hear us talk about it anymore, but it is true. And so I think that's something that maybe people are realizing now, that actually you can keep owning your equities if you have something else that can protect you. And the best protection doesn't seem to be always long volatility. Trend following is probably the best overall protection you can get against a equity portfolio. But now, of course, we also see that against a fixed income portfolio. So I think that was the first thing I was going to say. The other thing in terms of how much, to some extent, I guess it makes sense to try and set your managed futures or trend following exposure at probably the same level of volatility as the underlying equity portfolio you're trying to match. at least I know that we do at Dunne, we kind of show people what it looks like if you just had like a 50-50 portfolio of S&P 500 and our WMA program. And it's just a stunning outcome. Something as simple as that is just a stunning outcome, because you don't end up getting some kind of average of the two return stream. You get something that is better than any of the two return streams because of the negative the non-correlation between the strategies. So it is definitely something I think we'll hear more about. And as you rightly say, whether it's just a different terminology and labeling that makes it more appealing to people and make it sound more interesting. Sometimes we do need to come up with these labels to get the response we want from potential investors. So that's great, of course, that we keep innovating in that sense. The final question I just want to maybe answer as well, where Matthijs asked, well, do you need some level of volatility targeted trend following strategy in order to do this? My answer here would be no. I don't think you do, because even if Jerry doesn't target volatility in his strategy per se, then you still have a pretty good idea of what the volatility of his strategy will be, because he's got a long track record, along with other managers would be the same. So I actually don't think so that part of it, I would not actually say that there's any difference. You have to evaluate the trend following strategy based on its track record and on the methodology that's been used. You obviously have to understand whether it's been the same methodology being applied throughout the whole track record or whether it's changed over time. But other than that, no, I think you can use most trend following strategies from established managers. I would always go with an established manager, as I'm sure everybody knows that I would say, especially for things like this, you need a long data set to get an idea of whether this would work or not. So yeah, very interesting. And then in addition, or in sort of following up on that, we got another question that is somewhat related, and both of us, when we looked at the question, we thought, it's not our strongest side to discuss this topic, but Eduardo did write in, so we're going to give it our best. And he writes in and say, hello, I have two questions. First, what is your opinion of adding CPPI? And I had to look that one up. It's apparently constant proportional portfolio insurance on top of trend following. I like the fact that is a way of handling risk by looking only at your account value. Second, what is your opinion of using options on trend following to manage risk and also for constant cash flow? Thanks. So let me just deal with the second one here, because we've talked about this many times on the podcast, Eduardo. I'm not a proponent for using options in trend following. I think if you want to do trend following, do it the classical way. Don't try and be too clever, and anything to do with constant cash flows, I don't think that fits into the trend following world. If there's one thing we can say is that we don't get constant cash flows in trend following, so don't try and enforce that on a trend following system, in my opinion. Other people may have different opinions, and then that's fine. But in terms of the first question, we were quite sort of quickly discussing this before we pressed record today, and one of the best examples we can think of, just to illustrate what this might be, is actually another thing that I did when I worked with Jerry back in the 90s, where if you think about it, back then we had high interest rates, or much higher interest rates than we have now. So back then it was popular to package trend following strategies into quote unquote guaranteed products, is what they were sold as, where you took 80% of the money that you got from the investors, you put it into a zero coupon bond, because you knew after 5 years that would give you $100, and therefore they would get their money back. That's the guarantee. But you still had then the 20% cash left that you could then use for margin purposes, and therefore overlay a trend following or embed a trend following strategy in there. All you need to make sure was not to blow up that 20%, so it would go below the cash level that you had. Now, I did look up CPPI on the internet, and there's obviously many variations of this kind of protection strategy, et cetera, et cetera. But I from my perspective, at least, I want to keep it super simple. And so I do think that, if you can do something as simple as a zero coupon bond, and then take the cash that you know for sure you will have, unless, of course, the government that you're getting the bonds from goes default. But anyways, assuming they're not, then I think that actually works really well because, as you alluded to earlier, trend following is great because we use futures and we can get the inherent leverage we need to deliver a decent return without having to use all 100% cash, right? So I actually think those products work really well. They don't work, of course, when there's no interest to be had. You can't then do the zero coupon bond. Personally, and I'd love to hear your thoughts on this, Alan. Personally, I'm a little bit against making products too complicated where you start adding all sorts of other risky assets and you know, also your risk-less assets could be made up of different things and so on and so forth. Because do we really know what riskless is in an environment that constantly change? I'm not sure we do. But something that I could still believe in would be a zero coupon bond issued by a reputable government. I still think that's probably riskless. Or as riskless as it can get. But there isn't any opportunities at the moment. There haven't been for, many, many, many years. So that's just how I see it. So I'm not against the idea. I just think the environment right now doesn't really give us any opportunities. So I'll let you comment on that. And maybe if you want, you can talk a little bit about the other question that Eduardo had, which is something about rolling, when to roll, and so on and so forth. And then we'll dive into your papers.
Sure. Yeah. No, I think I haven't massive experience of CPPI structures. I have come across them in some structured products before, and that's typically, I think, where they seem to be used. And as you say, it's kind of combining a risk asset or a risky exposure and a so-called risk-free exposure. So I'm not. It doesn't. I'd agree with you. It doesn't strike me as something that naturally necessarily fits with a managed futures portfolio. Not to say it couldn't be applied to it, but as you say, in the current environment, obviously rates have been very low. So a lot of these structured products didn't work so well when you didn't have much of a coupon or much of a discounted rate. If you go back, as you say, to the 1980s and 90s when rates were higher, we tended to see more of these types of structures where you could either, as you say, take that spare cash that you don't need to buy the zero coupon bond and either use that as margin or else use it to buy an option, was the other way. So I know Man used to have a big business in terms of structured products as well. So yeah, I think at lower rates of interest, that becomes less attractive because you've less capital to play with. My experience with CPPI structures is you often found that, on the risky side, they could ultimately get stopped out and you wouldn't have any exposure then. Obviously, that depends on how you calibrate them in terms of the risk. So yeah, I don't have much more insight apart from that I haven't had great experiences with them, but yeah, that's not to say they couldn't work, particularly in a higher rate environment, I guess.
And in terms of the rolling...
yeah, the roll question was interesting. So the roll question then was about basically when's the best time to roll the futures contract? And actually, Eduardo raises an interesting point that could there be a possibly illiquidity premium from rolling later, which is an interesting idea. I mean, what you typically find is that traders will roll as the open interest and the volume shifts into the kind of the second year contract. So that's kind of an industry standard. Some managers then have kind of, I suppose, what you call alpha strategies around the roll. So if you go back, 10 years ago, there used to be a lot of money in index commodities, long only via futures, and they all had to roll. And then people became aware of that over time. So anticipating those rolls is part of what some managers do. And there's a more generalized set of strategies that come from what you might call institutional friction. So that traders or certain types of managers or asset managers have to roll their exposure, and people try and anticipate that. So on the illiquidity premium, by being later, the one idea and thought that came to mind around that was crude oil in 2020. So you might remember crude oil went negative right on the last couple of days before expiry.
Yeah.
But most people would have been out of the contract at that stage and had rolled into the second. So if you had actually stayed short the front contract, you would have captured all of that move down. So it's an interesting idea. So there might be that that illiquidity, as you say. I haven't looked at it, but it is something that I'm sure people research. Bigger managers obviously won't find that attractive because they get out because of the liquidity. So they don't want to be vulnerable to these kind of erratic moves close to the final couple of days, where liquidity dries up, and then obviously the ultimate risk is you might have to deliver. So that's, nobody wants that scenario. So yeah, possibly. I haven't heard of it, but it's certainly something that there could be in existence. Have you you any experience of that?
No, I mean, I guess my general view is the following, that we are stewards of other people's money, and I just don't think we should take those kind of risks. I don't think that's what we're being paid for, frankly, to take illiquidity risk. Certainly not in managed futures. We say that we're a very liquid strategy, so to get into anything that's not liquid, frankly, to me, is a bit irresponsible if you're doing it for other people's money. So I'm not a big fan of that, even though I know that there might be a little bit of alpha somewhere to be found, but there could probably also be a lot of other issues. And generally speaking, I would say that I think one of the challenges that investors are facing going forward is actually liquidity. I think that it's being repriced. I saw some headlines this week. You mentioned CalPERS earlier today, and I remember that they were talking about maybe a year or two ago that they would add leverage in general to some of their investments, and they would just buy more of the stuff they had. But then I saw a headline this week where they had to get out of a lot of private equity stuff at very low prices, because clearly there's very low prices at the moment for these things. So this is what I'm concerned about. And actually, if I take off my trend following hat for a second and say, what are some of the risks? And I've mentioned this before. One of the risks that I see going forward with all of the things happening in the world is actually liquidity in various assets. And of course, we know trend following because it's liquid, it's on exchange, and so on and so forth. It has in the past often been used as kind of a way to raise cash, certainly during COVID and certain other crises, because other strategies simply couldn't provide that speedy conversion to cash for investors, so they used their managed futures part. And I don't think we really get the praise we should for being able to deliver, not only the transparency, but also the liquidity in the strategy. So, yeah, I'm worried. And if you believe in, as I kind of tend to do, that we may see the reversal of the last 20, 30 years as interest rates starts to rise more secularly and as deglobalization maybe takes a hold, then you would also think that in terms of an investment, that many of the things that have worked well in the past are the things that are not going to work so well in the future. And that could be some of these less liquid strategies that people have just enjoyed for the last 20, 30 years with lower yields and nobody asking any questions because all traditional assets just went up. We may see some change to that. So, I just like trend follows to make money from trends.
Yeah, I think you're right. It's not something that managers are being paid to do. I mean, you invest in a managed futures program for the directional trading characteristics and not to kind of extract an illiquidity premium, for sure. So I think that's a good point.
Yeah. All right, Alan, it's almost over to you now because you've got some topics you wanted to discuss, and I'm not entirely sure where you want to go with this, so I will just try and listen carefully and add a few hopefully thoughtful comments along the way. So where are we going to go today, Alan?
Yeah, so I mean, I've kind of three papers that kind of linked together, I guess. One that I wrote myself, just posted on our website yesterday, kind of more just describing some of the interesting features of the current market environment from a kind of a macro and market perspective, and then a couple of papers on asset allocation, one from Bridgewater and one from Robeco, which tie into that and this whole narrative that maybe this risk of a more prolonged stagflationary environment might be underestimated, and what that means for returns. So first of all, in terms of my own paper, it really struck me recently, as you were saying, that there is an unusually high degree of uncertainty out there at the moment. I know it's a bit of a cliche to say, the outlook is uncertain. It always is. But, one of the things that I saw is that, JP Morgan were calling for potential of crude oil going to $380, while in the same week, Citibank were forecasting $65, So it's pretty big spread of opinion there. And then in terms of the rate outlook, I saw some people calling for the Fed to be cutting rates by year end. And equally, there's others out there saying that the Fed might have to go ultimately to maybe 8%. So again, this massive spread of opinion. And I think a lot of that is reflecting the fact that we're in an unusual cycle here, and I think there's three big uncertainties at the moment. One, clearly it looks like the economy is going to slow, but how much is it going to slow in response to monetary tightening? And then two, how much is inflation going to come down in response to weaker growth? And then three, I think there is also an uncertainty, although it's not really been acknowledged in the market yet, about where does the Fed ultimately want to get inflation down to? Obviously, they're still saying 2%, but is that really the case? So just, why is it so uncertain at the moment? And I think one of the reasons for that is, if you look at this cycle versus past tightening cycles, there's a few reasons that make it very different. One, obviously, the big thing is that in the past, in the last couple of decades, the Fed has always been tightening preemptively. So, core CPI, core PCE was always 3% or less at the start of the tightening cycle. And it was about, cooling the economy to make sure that inflation didn't get out of hand. In this cycle, inflation has already got out of hand. The genie's out of the bottle. So that's the first thing. So we're into a cycle where the Fed is actually trying to actively slow the economy to bring inflation down. A corollary of that is, because inflation's already gone up, the starting point is one of dramatically negative real interest rates. So obviously, based on CPI, real interest rates would be minus 7% or so. Even if you take the core PCE, you're still looking at minus 3-4%, which is very unusual relative to the recent history. And standard economic textbooks, it's all about real interest rates. Now, whether that's right or wrong, we don't know. But it's a very stimulative starting point. The other thing now, what we're seeing is, because the Fed was slow to get started, they're now kind of catching up. So we're actually seeing rates going up at the fastest pace, going back. We haven't seen 25, 50, 75. Based on the monthly average, this is a faster pace of tightening that we've seen going back, back to 1980. So this is unusual. So how do you balance the fact that, on the one hand, rates are really low, they're negative in real terms? There's signs, clearly, as you say, of a slowing economy. We can see that in the housing market. You can see it in the ISM, new orders index. You can see it in a lot of these forward indicators. But at the same time, unemployment is still low, and the labour market is still hot. And net, what the market is saying, the market expects rates to get to about 3.5% if you look at Euro-dollar futures, but then to be rate cuts by next year. So, does that look reasonable? Yeah, maybe not. I mean, I think the experience of 2018, 2019, where the Fed was tightening and then cutting 7 months later, I think that's in the market's mind, and they think, that's going to be the scenario. But, given the uncertainty around all of those factors, the fact that, you've got pros and cons on each side, I think it's very hard to say, with any great precision, how much growth is going to slow. Clearly, the Fed wants growth to slow, but they don't want it to go to below zero. So I think that's the first big uncertainty, and lots of kind of debate about that. The second thing is really about this relationship between inflation and unemployment, and it's captured in the Phillips curve, and anybody studying economics will know that the Phillips curve is a hotly debated topic in economics, going back to the right throughout the history of macroeconomics, and used to be a very stable upward sloping curve back in the 1960s, and then the policymakers thought they could take advantage of that and, bring unemployment down to live with a certain level of inflation. And then what you got in the 1970s is people anticipated these policy actions and inflation started to rise and you had stagflation. Central bankers then became aware of this and started to inflation target, and they managed to I suppose, flatten the Phillips curve was their perception. And if you go back to 2019, a group of academics wrote a paper, is the Phillips curve gone or is it hibernating? And so my perspective on this is it's back. If you actually plot the relationship between unemployment and inflation, it looks a lot more like the 1960s now than it has at any point. So the question is, historically what economists would ask is how low can you get unemployment without pushing inflation up too much? But at the moment, the question you have to ask yourselves is, well, how high do we have to push unemployment to get inflation back down? And the interesting thing is, if you look back to history, like say if you go back to, I went and looked at all of the recessions back in the 1960s, 70s, and really in those recessions, the unemployment rate rose by 2.5% between 1969 and 1970, and the CPI hardly budged. The core CPI actually rose. CPI itself was down 30 basis points. So if we're back into that kind of more like 1960s, 1970s environment, the point is that the cost in terms of unemployment could be much greater than the market is anticipating. And I think that's important because at the moment, we've had this unusual situation that there's been widespread political support for higher rates. Biden is behind it. Democrats, everybody is tackling inflation as number one priority. That's fine in a strong economy, but if you start to see inflation rising by 2-3%, will that political support remain? So I think that's an important point that's been underestimated by the market, and that leads you to the final point. Well, then, ultimately, if that cost starts to become more apparent in terms of higher unemployment, how low does the Fed really want to get inflation down to? They're still saying 2%. But there was an article recently from Paul Krugman saying, how low must inflation go? And his point was, from an economic perspective, there was never really any strong basis for 2% for these inflation targets, rather than 3% or 4% or 5%. It was just that was what was picked, and now we've got to maintain credibility by keeping it at that level. But back in 2010, Olivier Blanchard, who was the chief economist at the IMF, wrote a paper arguing for 4% as a better inflation target. And the reason for that is obviously when you get into a financial crisis, if you have a higher level of inflation, you can bring real interest to a more negative stance. One of the challenges we've had in the last 10 years is real net rates couldn't go that negative because you brought nominal rates to zero and inflation stayed low, so real rates couldn't get negative. So I think this is something that is going to come back into the market, that people will start to say, do we really need to get back to 2%, or would 3% or 4% be okay? And I think that's something that is underestimated by the market, because if you look at five-year forward inflation expectations, that they've come back down, still in the range we've seen for the last 10 years. So the market is pretty sanguine on inflation. The market is saying, okay, inflation is going to be a problem this year and will normalize maybe next year, the year after, but longer term it's not a problem. But that seems to be reflecting an awful lot of complacency, and I could really see a good case where the politicians start to lose their resolve, and then that influences the central bankers. And I think what that could mean from our perspective is, the Fed's talking about being humble and nimble, and that means probably more reactive to the immediate data as opposed to kind of forward projections. So that to me means more volatility, probably more opportunities for macro and directional strategies like trend following. So kind of, maybe a long-winded way of getting to the same point that we like to make, that, trend following is a good strategy for this environment. But I do think certainly there's lots of aspects of the current environment in terms of, this tightening cycle that are very different from what we've seen in the last 2 decades, and much more like what we saw in the late 60s, 70s and 80s. And actually, I'm starting to do some more work in the 70s. It's early days. I'm going to write something on it soon. But there is this perception that, the 70s, it was this inflation burst. It was all linked to the oil crises. But actually, we saw the first burst in inflation in the early 1970s. It was very similar to what we're seeing now, very much commodity-led. By the end of the 1970s, it was a very different type of inflation. It was being driven by a lot of bank credit and borrowing, and people were just, the inflationary psychology became so embedded that people were borrowing to consume, so that they could consume ahead of price rises. So I think it's not a simple case that, we just had an oil crisis and a wage price spiral. We had different types of inflations as you went through the 1970s. And so expecting just one surge in inflation now and then everything to normalize seems to be maybe a bit naive from my perspective.
Yeah, I mean, lot of things to unpack in all of those statements. I'll just give you some of my thoughts as they come to me when I hear you speak. Well, first of all, just in terms of comparing these periods to historical periods, I think in itself is troublesome, right? Because first of all, can we compare the current FOMC board with what was in the 70s? I mean, they're different human beings. They're going to be reacting differently. And even you can just compare the Fed and probably other central banks, how they change over time. So at the moment, I would say the sentiment that I get is that they would rather have a policy error by tightening too much, right? That's kind of the framework. If we're going to be wrong, we're going to be wrong by tightening too much, right? But only a few years ago, that was complete opposite. If we're going to be wrong, we're going to, we better lower interest rates a bit too much, So those kind of shifts, subtle as they may be, are quite important to pick up on. That's one thing. The other thing that I find interesting is that when we compare to previous periods of inflation, we just talk about inflation. But I think that there are two types of inflation. There's the predictable level of inflation, where it's kind of constant, it's going to be there. You can calculate it into your business models and you can price your projects accordingly, and you'll be okay, and you're okay with also committing long-term investments because you have something you can put into your own planning, so to speak. And then you have the unpredictable inflation, which is what really makes it difficult to get any company to make long-term investments because they really don't know what to plan for economically. And I'm not an expert, but I get the sense that the 70s were more unpredictable than the 40s, which is another era where people are comparing. Now, I worry personally that the inflation or the inflationary regime we're in right now is the unpredictable inflation. So I can easily see these things change a lot. And I also worry that the reaction pattern from central banks will be driven by very short-term data, really, which will make things even more unpredictable, so to speak. It's going to sort of reinforce the whole feedback loop. So again, that's another thing to put into the discussion. Love to hear your thoughts on that. Thirdly, I would say another thing that's very different from any of the previous periods, as far as I can tell, is debt levels. I mean, how are we going to compare ourselves to a period where we had very little debt in general, and now where we can't afford interest rate levels to go back to quote unquote the norm because it's going to be so expensive for companies and governments to pay for their liabilities that they have built up. And then you mentioned also unemployment. And I'm again thinking here, well, can we even compare what is unemployment today when you have so many people who work for several employers? They're freelance people. They get their jobs on Fiverr or some other website where they just pick up jobs. I mean, how can we even compare a period like today with a period in the 70s and the 40s and even the 80s and the 90s where people were employed by one firm at a time and where, we didn't have the type of economy we have now? I think that's also a challenge and it's a difference. And I think it's important. So I don't even know where to begin. This is why I said to you before that I'm so grateful, really, that we as trend followers don't have to try and make sense of all these different forces. All we need to do is to look at the price and keep that as our focus. So that's kind of how I feel about it. I think there's so many things that are, that we have no idea how they're going to evolve.
Yeah.
And you can, on top of that, by the way, Alan, on top of that, you can, of course, add geopolitics, climate change, all of the above, where we have no idea, really.
Yeah,
where
you're right.
Go.
And I think that's something that came up in the minutes, to your point about that shift from the Fed. They're talking about the risk management approach. It's something which they talked about before. It's like, okay, you don't know what the future is, but based on a risk management approach, it's, as you say, it had been prudent to be easier. Now it's been prudent to be more tighter. I suppose my thinking is on all of this is that the central bankers have a bit of a sweet spot at the moment in terms of tightening, and there's no adverse impact yet. But what about if and when we get to recession, and how challenging is that for people? And then if you don't get that fall in inflation in response to that weaker economic scenario, it could be for lots of reasons. It could be because of supply constraints. It could be because wage demands grow, or it could be for random situations like geopolitics. For all of those reasons, that's where you get more of a policy dilemma. And I think that's where it gets interesting, because I think that's what you saw in the 70s as well. And this is more of a behavioural thing that I don't think changes. Is that when it's easy to do something, people do it, and when it gets hard, will the resolve still be there, and how does that play out?
Well, just on your point about these oil predictions, where some people are predicting $360 oil if really things starts to escalate in terms of Russia and the energy crisis, et cetera, and other people say $60, et cetera. We only have to go back 2 months, where there were a lot of people talk about this commodity super cycle, and everybody was going to jump on that bandwagon, and so on and so forth. We even had a guest on the series where they run a long, broad commodity index, and of course they were saying that they were seeing tremendous interest from all these pension funds, et cetera. Well, lo and behold, pretty much ever since that conversation, commodity prices have gone down, not by a little, but by a lot. So it shows you how difficult it is to predict anything, I think. And this is also why I think a lot of investors end up getting it wrong and having these bad experiences, because they jump in at the wrong time, and they'll probably close out some of these exposures at the wrong time as well. So I think that's really interesting. But it does beg the question. I don't know whether that's in the other paper you refer to as well. But what it all comes down to is, so what do investors do? How do we build portfolios for different regimes? And so if you have some thoughts on that,
I mean that basically comes to the Bridgewater paper, which is about building a beta portfolio in an environment that looks difficult for assets. And basically what really struck me about this paper is that they say, basically they're saying, like, as we are, that the markets are, facing drastically different circumstances, as they say. And they have a chart in here that basically says that the risk of stagflation is at the highest in 100 years. Now, they don't go into how the chart is constructed, but my reading of it is that it's probably looking at maybe their growth estimates versus what the market is discounting in terms of earnings growth, and their inflation forecast versus what's inflected in kind of tips and inflation expectations. And based on that, the market is significantly underpricing the risk of stagflation. And obviously Bridgewater have this all-weather approach of a balanced portfolio. And, they do make the very valid point that, the kind of typical or traditional portfolio, what you see, most maybe endowments or, typical asset allocation plan is like, 50%, 60% equities, 20% bonds, credit, emerging market bonds, a few hedge funds, etc. Those typical portfolios are biased towards, they're favored by better than expected growth and lower than expected inflation. That's the best scenario for those types of portfolios. So if you get the opposite, then obviously your traditional portfolios are going to underperform. So their whole message then is around better balance, which is the all-weather portfolio. And I mean, the big difference from their perspective is obviously having that balance with the higher inflation protection via commodities and tips. Now, tips are another interesting one because they've obviously struggled this year as well, because obviously they're fixed income instruments and real yields have risen. So tips actually haven't done that well in the last few months. But obviously you got the benefit from the commodity side. So this is all about a beta portfolio. But I think when you look at their paper, you could take all of those arguments and use them as arguments for incorporating trend following, as another way in the first instance for getting commodity exposure. And as you say, it's a managed commodity exposure, not long only. So you're getting that benefit. But all of those reasons are reflected. And this kind of fits in nicely with the final paper from Robeco, which they look at different the performance of different asset classes and factor premia in different inflationary regimes. So they go back to 1875 in their paper. Interestingly, they showed a number of inflationary periods which they define as more than 4% in that whatever that is, 150-year period. And I think there's like 45 or 44 years are actually, which feels like a lot. It just shows you that how unusual the last kind of few decades have been in terms of being low inflation. But again, they point out obviously the tough performance of traditional assets in the stagflationary periods, and they look at different what they call factor premia, like value factor, and in equities and in bonds, and then kind of what they call global factors. So the trend momentum in the global factor is the equivalent of trend following. It's a very simple trend signal. But what's interesting is really when you look at their data is how robust trend following performance is across different regimes. It's almost as strong in all of the regimes. It's best, obviously. Well, not obviously, interestingly, what we would guess in a high inflation period. And that's consistent with the paper from Mann that was out last year about the best of strategies for inflationary times. Very much consistent with that. But it is interesting how well the trend and momentum positive also in deflationary environments too. And actually they break it down into within the inflationary and deflationary periods of recession, earnings up and down, equities up and down, rates up and down, inflation up and down. And actually, momentum is positive in each of these subcategories as well. So yet more evidence in favor of trend, but certainly strong evidence in favor of if you're in the stagflationary episode, which is basically, in their paper, high inflation and in a recession, equities in that type of environment are down 7% on average, 7% per annum, whereas momentum strategies are up 7.3%. So there's the evidence, there's the support. What do you do for a stagflationary environment? So I think, a lot of people coming to the same conclusion. If this is really something that is an underappreciated risk, it's more evidence in favor of incorporating trend strategies.
Yeah, it's funny when I hear you say that. It obviously kind of suggests that trend following is a strategy for all occasions, right? And that's obviously something that we believe and have done for decades. But again, it just strikes me when I hear you say it, of how little, or how few people have adapted that as their philosophy as well in the institutional space. Maybe this time will be different and people will come to it. Who knows? But it is striking that with all these papers and evidence that comes forward, that it has not made its way further into institutional portfolios. And then when it does make it into an institutional portfolio, it ends up having like a 2 or 3% allocation where you kind of think, it doesn't really matter if you do it or not. But there are a few, and obviously we're kind of trying to get some of them on the allocator series, where there are pension funds who have really made it a much more of a core allocation, especially inside their risk mitigation buckets. And I remember my conversation a few years back with Carrie Lowe at Calsters. So if Carrie, you're listening, we definitely want you back and give us an update on that, because it is important to have some practitioners who have gone now through a couple of different environments to talk about their experience, and maybe that will be what convinces other institutions to to take the next step, because that is another. We talk about uncertain things. That's another uncertainty, and that is how our pension funds and other groups that rely on having to pay out and to meet liabilities, how they're going to do that if they are already underfunded, and now you have a period of time where perhaps both equities and bonds might underperform. As they did in the 60s and 70s.
And obviously high inflation then influences their liabilities as well.
Yeah, no, absolutely. So definitely worth staying close to that debate. Anything else you kind of want to add before we wind down for today? Anything that we've missed from these papers, or any kind of...
No, I think that was it. I mean, as I say, a lot of evidence and research all pointing in the same direction, and saying, that the market is maybe a bit complacent on this stuff. So, it struck me, the Wall Street Journal had an article yesterday about, different strategists' views on the equity market. And it seemed to be a lot of optimism around. I was surprised, to be honest. A lot of people saying, inflation is peaking and, rates are going lower, and, things are going to be okay pretty soon.
Well, there's two things to say to that, Alan, and that is, one is that we have to always remember that most of the people who are talking about these things today, and most of the people who are managing money today, are people who have only experienced the kind of 2% inflation target and central banks achieving that, right? They've never tried 5, 6, let alone 10% inflation environments. So it's that, I think, human natural bias towards things staying the same that we see reflected in all of those comments. So that is not surprising to me, which is also why I think they are criminally unprepared for what's coming. So which is scary, frankly. I can't remember the other point I wanted to make about that, but it's probably not that important.
Sure, we'll get it next time.
I'm sure. I'll remember it in like 30 seconds when we end up this conversation. But no, thanks for all the prep work, Alan, and taking us through these papers. They're definitely important, and I will of course link to your post in the show notes today, where people can go and read more about it. I think that's going to do it for now. We are, of course, grateful if any one of you would go and leave a rating and review in iTunes and Spotify. That always helps. Next week, I'm joined by Rich. So we're going to go into some hardcore, I think, trend-following concepts, perhaps. We'll see. Depends also very much on the questions that we receive from all of you. So if you could send them early in the week, that would be great. info@toptradersunplugged.com is where you would send them, and we'll do our best to answer them. And I think that's pretty much it from Alan and me. Thanks so much for listening, and we look forward to being back with you next week. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.